Hello and welcome to Moneylife. This is Sucheta Dalal. We are all expecting the election results. Are you nervous? Well, I don't know if you're an investor, but if you are, you better be nervous. I believe that the Indian capital market, with a market capitalization of $5 trillion, is like a powder keg, and the least thing could set it off. You don't believe it? Well, then you probably started investing in the market in just the last 3 years. Less than a week from now, the election results will determine who governs India. Historically, this is a time when markets are jittery. Not this time. This time, markets are unusually calm even after a ferocious bull market. Does it mean that everybody is very calm and unconcerned? Actually, not. Those investors who actually witnessed, forget 30 years, just the past 15 to 20 years, know that anything could happen on results day. So they've seen a market crash in 2004, which was so severe. They've seen a euphoric rally in 2009. And believe it or not, both times market sentiment was completely wrong and out of sync with the actual results. In fact, for those of you who think that the Falodiyas of Rajasthan know exactly who's winning, then think again, because why did the market get caught on the wrong foot? Anyway, this column is not about predicting election results or the outcome. It is about questioning whether political parties, fresh out of an unusually nasty election campaign, understand what is the structure of the market and its implications. Like I said, we have a market cap of $5 trillion, and it is like a powder keg. It is too much, too high, and anything can set it off. This could be an ill considered statement, some bombast. It has happened in the past. History shows that what I'm saying is not at all far fetched. In fact, it's public memory that is short. And those of you who quickly Google, you'll realize that even Google has very sketchy details of what happened even 10 and 15 years ago. Knowledge of past behavior is crucial today because millions of investors who've joined the market in the past few years have never experienced a serious correction. Forget about a prolonged bear market. Most of them have an investment span of 3 years only, where stock prices have just moved in one direction, up, up, and up, barring maybe a couple of small blips. Now, for starters, let's look at this in the context of what is the market structure? Who are the investors? Until 2009-10, India's investor population, believe it or not, stagnated. Long time ago, when mutual funds were included, we used to say that there are 2 crore or 20 million investors in the market. After that, with all the electronic trading and the positives that came, the investor population actually dipped. People had lost so much of money repeatedly in all kinds of scams, including the IPO scam, that they had just moved away from the market. And at one time, the investor population was estimated by official reports as much as 8 to 11 million. 8 in one report, 11 in another. Moneylife has covered this extensively on our website. Those of you who are curious can go and look it up. Now, there was a dramatic change post-COVID, not just in India, but around the world. So post-March, people were confined at home, people had a lot of time, and techies realized that online brokerage firms allow you to trade sitting at home. You can access your bank account, everything is nicely linked, and you can also connect to an algo. There are people sitting and writing retail algos and promising you assured returns. So people just began to get into the market because as a source of revenue, as a source of additional revenue, as a source of beating inflation and earning more than your fixed deposit. Once people began to say that they're earning money, then there were the influencers and people with quick trainings. Everybody thought that all it takes is a couple of hours before you're expert enough, buy an algo, register an account, and you're good to trade. Look at the manner in which the number of investors have surged. As of February 2024, the National Stock Exchange tells us it has 90 million unique investors. Of these, 10 million registered in just 5 months. Now, if you add it all together, including the BSc investors, there will be some who are unique to the BSc. There will be some more who have come in after February 2024. India probably has 100 million investors today. Look at the numbers. I'm talking about the best case scenario earlier of 20 million down to 8 million, which means that 8 or more out of every 10 investors have come into the market only in the last 3 years. Most are young, 20 to 30 age group, maybe 20 to 40. They have not seen a bear market. They have not even seen a serious blip. What they have seen is the Nifty 50 rising from around 9,000 to 22,888. Take a look at this chart. So naturally, they're just full of sunny optimism. Nothing's going to happen. No worries about election. NDA will be back in power and the bull run will continue. These are direct investors. Now let's look at indirect investors. Who are these? These are people who said, why am I missing out on the rally? It's too much trouble to understand how to invest directly. Let me believe this campaign, mutual fund sahi hai. So watch an IPL, look at anything, you're bombarded with the message, mutual fund sahi hai. What do? You start SIPs, systematic investment plans. Do you know that Indians today are putting 20,000 crore per month through systematic investment plans or SIPs? And how many investors? 87 million investor accounts, according to the Association of Mutual Funds of India. In fact, so aggressive has been the investment through mutual funds that the total assets under management of all mutual funds is 57 lakh crores as of April 2024. Indian mutual funds are the biggest force in the market today. I remember when I began to write, we used to talk about institutional investment, which used to be your LIC and ICICI and others, to development finance institutions. Then the market moved on the basis of foreign institutions or foreign institutional investors were doing. Now the biggest force is Indian mutual funds. So take a look at what foreign portfolio investors have been doing. They sold a whopping 119,000 crore worth of stocks only from Jan this year, steadily anticipating the elections. What did Indian mutual funds do? They countered it by pumping in 197,000 crore into the market to keep the bull run intact. So there was zero impact of foreign selling. Now, if investors in India, there is a sudden crash or sudden reaction to election results, and Indian investors begin to pull their money out of mutual funds, most people do, then the mutual funds will have to sell willy-nilly because people are now exiting rather than coming in. And it's going to hurt everybody because they have to sell stock to create liquidity, meet redemption pressure. This affects even those who decide to hold on. So it's all very well to read the legendary investor Warren Buffett saying our favorite holding period is forever, but the reality is that investors are human. They rush for the exit door during a panic and they don't want their paper profits to vanish. So they say, let's at least book the profit right now before it crashes further. When this happens, the logic of long-term value, excellent corporate performance, everything that has justified every day of the bull run just is thrown to the winds and ignored. Blue chip stocks are less impacted, but they aren't immune to a beating when the market crashes. We haven't even now discussed the speculative froth in small cap stocks. These are the stocks that have been rampantly manipulated. They've shot up 300 to 1000% in the last few years, last few months. These stocks, historically, every time there's a crash, there are what they call penny stocks, small cap stocks, which are completely pumped up. They crash 80 to 90%. These are not usually in mutual funds, but they are. They are there in portfolios of people and they're there in mutual funds also. Another big component of the market today is the massive volume generated by derivatives trade. The volume of speculation through equity derivatives has touched 6 trillion US dollars. The finance ministry, we read, is concerned about unchecked retail participation. Like I said, they all buy algos which promise surefire results, and they are trading in the market. In fact, the Futures Industry Association has said that India accounted for 84% of all equity option contracts traded globally last year. That's how much of fraud there is in the Indian market. Now, SEBI has done a study. So, the Securities and Exchange Board of India did a study trying to pull the market down. It was released last year, 2023, and it said, believe it or not, 90% of active traders in derivatives lose money. Did it have an impact? Zilch, as can be seen by the results and how the market is moved. In fact, SEBI has gone a step further and told all brokers to have this pop up on their screens every time investors log into the trading portal. So you're reminded every time that look, 90% of the people lose money, but investors are unfazed and continue to speculate. On the flip side, there are people making a lot of money in the Indian market. The Economic Times reported in April that Jane Street, a quantitative trading firm, earned $1 billion in 2023 alone through a highly profitable trading strategy, which is an algo. Now, two employees of Jane Street apparently stole this trading strategy and moved to Millennium Management Global Investment, another trading firm, which also deployed it in the Indian market. And Jane Street has sued Millennium Management for stealing this strategy. It just goes to show that there are people making a lot of money. In fact, maybe a lot of foreigners are making a lot of money at the cost of Indian speculators. All this could vanish if there's a sudden crash. Now, what exactly am I saying about June 4th? Am I saying there's going to be a crash? No way. Nobody knows. So it could well be that there will be a complete anticlimax. Many of you may not remember the big hawa and noise about Y2K, how the world and all the computers were going to come to an end. Nothing happened. It was a damn squib. So for all you know, nothing may happen on June 4th. Maybe the market will continue as usual. People are happy. So nothing happening is one scenario. Positive scenario is possible. People may be very happy with whoever forms government. And like 18th May 2009, market could shoot up. In fact, in 2009, when the UPA came to power, there was such euphoria and the index shot up so much that it hit a circuit breaker and trading had to be halted. This is UPA 2. Sensex shot up 17% in a single day because of this upward surge. Now, 5 years before that, when UPA 1, which is considered the better UPA governance term, when UPA 1 came to power, thanks to a lot of ill-considered statements and a coalition government, it was 17th May 2004, the market crashed so badly. First, it was shocked that the Bharatiya Janata Party had been defeated. The India Shining campaign hadn't worked. Then there was a lot of muscle flexing and ill-considered statements from Communist Party leaders. There was a television interview where someone talked about smell the coffee to one of our largest traders. There was such panic that when the market opened, stocks crashed 10% within the first 20 minutes, halt in trading for an hour. When it opened after the circuit breaker, it fell another 5% and it had to be closed for another 2 hours. In all, the Nifty plunged 17.4% that day. Hundreds of panicky investors took to the streets, shouted slogans, and of course, the government that was going to take charge desperately made attempts to pacify investors. Of course, there was something that was fishy that day, so there was an investigation. But once there is that kind of crash, it took 6 months before indices regained their earlier levels. Now, the investigation revealed that the panic was triggered by massive sales. At that time, computer-driven sales and algos was unknown. This time, it could well happen. Everybody is sitting on a computer where retail as well as institutional sales are automated. So it's that much more dangerous, and I call it a powder keg. So huge sales at that time in 2004 were pressed by Union Bank of Switzerland. And remember, we're talking about 20 years ago. In fact, many investors today are 20-year-old. They're probably just born. 12 entities were found to be beneficial owners. There was supposed to be some Indian link. Nothing is quite clear about what happened then. But this situation could be repeated, not just because we're using more algos today, but We are also vulnerable to concerted selling through unknown foreign portfolio investors, where the ultimate economic beneficiary is not known. Remember, the details behind the steep rise in Adani Group shares is not really known. Their fall after the Hindenburg report is also quite unclear. All we have is rumors about SEBI having identified some FPIs and planning to send out notices to some short sellers. It hasn't even been completed. It ought to have been completed long before the elections. So at a time like this, like I said, it's powder keg. We've had a very ugly, divisive poll campaign, one of the worst possibly post independence. We desperately need all political parties to respond to the election results with maturity and sobriety. Whether you're a winner or a loser, you have to think about the country, put national interest first, because it's not just about 8, 10 crore investors and the market. This has an impact on the economy as a whole, not merely investors. If you agree with what I'm saying, please spread the word. Please make people understand what we are facing today and what the consequences are. Because, like I said, it is not crystal gazing, it is not speculative hypothesis. It has happened in 2004, it's happened in 2009. And let's just pray nothing happens when results are announced on 4th of June. Thank you so much. If you like what you've heard, do subscribe to this channel.